It is the first week of September, and that means the August Vancouver real estate numbers are out. And spoiler alert, well, home prices have gone down even further. And detached homes, well, they are sitting well within a buyer's market, a term we don't say nearly enough in the Vancouver region. We also saw the Bank of Canada cut rates this week with a strong indication of even more cuts to come. With September being the start of a typically active fall market and a rate cut to kick things off, will September be the TSN turning point and prices will start to rebound? Or is this train just picking up momentum and prices are going to drop for the rest of 2024? We are going to share our insights into these questions on today's episode, so let's get right into it. So it pretty much you'll be guaranteed to hear that you heard the Bank of Canada cut rates this last week, and it was the third consecutive rate cut in a row, with the overnight rate now sitting at 4.25%. The markets were absolutely correct in pricing in that cut. Let's dissect what Tiff Macklem's comments were for insights into what Canadians can expect next from our central bank. And I'll preface this by stating that his comments continue to be increasingly dovish, meaning that the chance of more cuts based on at least today's data are extremely likely. First off, the cut was made citing the continued easing of inflation, right? That's basically their whole mandate, is to get inflation down to 2%. And remember that just a couple of weeks ago, inflation hit a 40-month low. With that 2% inflation target being the BOC's mandate, and the print coming in lower than expected, the writing was essentially on the wall for this week's rate cut. No surprises there. And while 25 basis points was expected, listen to this quote from the governor. He said, quote, "If we need to take a bigger step, we're prepared to take a bigger step," he said during a news conference on Wednesday. At this point, 25 basis points looked appropriate. I mean, talk about leaving that door wide open for a potential cut of 50 bips at the next meeting. Not that it's expected, but they certainly aren't saying it's out of the realm of possibility either. As of today, or as of that last rate cut, the financial markets reset their pricing odds and currently say a 93% chance of a 25 bip cut in the October announcement, with a rate reduction in December already fully priced in. And this data is coming from Reuters. So next two meetings, as of today at least, definitely look to have rate cuts happening. Tiff also went on to state that prices for housing and shelter are still maintaining upward prices on inflation, which is a bit odd, right? Because that almost sounds like lagging data that they're referencing, because we know that nationally, rental rates are certainly coming down, and as are home prices, at least when we take that sort of macro picture, and then been trending downwards here for months. So I think as that data starts to catch up, the BLC is going to see inflation rates coming down even further, especially within both the rental rates and the home prices rates, and obviously the amount of mortgage insurance too. But one more quote, and listen to this shift in tone. "With inflation getting closer to the target, we need to increasingly guard against the risk that the economy is too weak and inflation falls too much," said Macklem. I mean, when was the last time you heard the governor talk about his concern that inflation could drop too low? Talk about dovish. I mean, think of the stimulus they would want to do then. At its current pace, we should see the continued rate cuts at a quote unquote orderly 25 basis point pace until the bank reaches what they call their neutral range. That's between 2.25 and 3.25, and is currently expected to see that at some point in 2025. So the big question is, how will this and future rate cuts affect the housing market? Well, this is what the governor of the Bank of Canada predicts. And one more quote from him. "It wouldn't be surprising, as interest rates come down, as the activity in the housing market strengthens, you could see some pickup in housing prices." When I say overall shelter inflation could come down, I'm not saying that means housing prices are coming down. House prices could well pick up a bit. You heard it from the man himself. So that's what Tiff is saying. And I mean, it's you just look at history, right? If history repeats itself, so much of the housing market is driven by rates. And should rates get low enough, well, we know what happens historically. Activity picks up. When activity picks up, prices typically pick up. Ryan, what's your take on all this?
Yeah, interesting, very interesting comments. I think Tiff over the last couple of years, granted he's had a few flops and a few misses, but he's been fairly consistent with his tone, his tonality, and kind of his guidance without saying exactly what's going to happen. But if like you said, if history is any kind of prediction of the future, we're going to continue to see rate cuts and potentially bigger ones. He didn't really talk too much about the state of the economy as well. I mean, it's one thing to talk about housing, but I think the economy, largely is based on lagging indicators as well, is performing worse than what we think we're seeing. And so, I suspect that we'll continue to see consistent rate cuts well into 2025 and potentially some bigger ones. But again, I think that will also depend largely on what happens down south with our friends in the US. With that said, also, you can't really talk about rates without talking about bonds. So let's have a look at the 5-year bonds, as this is a great indicator for 5-year fixed mortgage rates. So how is the Canada 5-year bond reacting to this news? Well, the bond rate has dropped to 2.84% at the time of this recording. And that's the lowest it's been since March of 2023, the lowest in 18 months. Naturally, you could expect to see fixed rates fall in the coming weeks. There's been numerous articles out over the last couple of weeks here about how heavy the mortgage competition is amongst the banks right now. With low levels of transactional volume, it's getting quite competitive in that space. So, maybe some welcome reprieve for home buyers, though I don't think we're entirely yet in the realm of affordability, but it's trending in the right direction. With that said, too, let's also have a look at what's happening to the USD versus the Canadian dollar as a result of the release of this news, because, some of the brightest minds on Wall Street were saying if Canada, was the first one to drop rates and drop too far, it would crater the dollar. But that's not exactly what we've seen. And what was also really interesting, actually, Dan, I was looking at our podcast of when we interviewed Doug Porter earlier in the year, and that podcast is going to age very, very well. He also called, that we would be dropping at the pace that we're dropping at. He called it would be in June. And he also said that Canada would cut ahead of the US, exactly all these things that have happened. So very, very interesting to see that take place. But typically, Canada, when they lower their interest rates ahead of the US, it creates a problem for our currency. It means that we end up being weaker compared to our US counterpart. But something very interesting happened this time round. Canada's first rate cut happened on June 5th when the USD was about $1.37 Canadian. The dollar did weaken. It went up to $1.39. But then the next two cuts actually saw the Canadian dollar strengthen, now sitting at $1.35 US. And as of today, Canada's rate cuts have strengthened and continue to strengthen. It's not what a lot of people were expecting. This may be on the implications that the US Fed is about to cut rates as well, so there could be some hedging there, but we'll know more on September 18th when we see that anticipated Fed rate meeting. Where they are widely expected to cut, it could be as high as 50 bips, though I suspect we'll see more tempered. In my opinion, I think it's going to be more on the 25 points side of things. I think also what it shows too, and while we all want to have our opinions about central banks, it also shows that, Wall Street doesn't have it all figured out. And central banks have a lot of different levers and some very intelligent people working for them. So it's very interesting to see this play out the way it has.
Perfect. Now let's move into the data about the August real estate sales numbers, because as always, this market seems to move quite dramatically month over month, and August did not disappoint. Let's start off with the good old sales volumes, aka that health of the market. We've been talking about how incredibly slow or how low the sales volumes have been basically all of 2024, and that accentuated last month with just under 1,900 homes selling across GVRD. Year over year, that's like a 17% drop, and month over month, it was 23% less, almost a full quarter less homes sold than in July. Now, yeah, sure, it's summer, it's August, that typically dips, but this was more than average. It also represented the fourth consecutive month of decline in sales. And if we pull back and look at as much data as we have, last month was actually the fourth slowest August on record, only beat by the years 2022, 2012, and of course the GFC, good old 2008. Overall, Last month's sales were like 26 below that 10-year average. And again, this is just kind of the theme of 2024, just kind of sluggish, slow, grinding market. We saw prices kind of grind up and now they're kind of grinding down, and it's all based on really low sales volumes. What happens now? We've obviously just seen this third rate cut. Will that rate cut breathe some life into the sales volumes, right? There's a long way to go here before we reach even kind of like normal numbers. But like I said, the market grinds on. I mean, even when the overnight rate, the interest rate was 5%, which lasted almost a year, there were still almost 8,000 homes that were sold during that time. So, the market does move. Regardless of rates, but obviously if rates go lower, we can expect sales volumes to increase, and time will tell, right? We've historically, last two cuts, only seen new listings or sellers essentially get stimulated by the rate cuts. So we have yet to see which rate cut will trigger the buyers to come back to the marketplace.
Yeah, and I think it's going to be a mixture of cuts and price elasticity. I think as those things start to level out, we'll start to see more activity take place. I just don't think we're there quite yet, but it's coming. New listings here sitting at 4,109. That's a 4% increase year over year and a 36% decrease month over month. It sounds high, excuse me, but that's very typical for August. This is the fourth month in a row where we've seen decreasing levels of new listings. Though there's still no real panic selling taking place, and this is 2% kind of below the 10-year seasonal average. So oddly, maybe finding some equilibrium here, kind of finding some balance. We'll see.
Let's jump into inventory, the forever interesting story of inventory. Today, or at the end of August, about 13,250 active listings. Okay, big jump year over year. I mean, we're talking up 30%. So way more homes available on the market last August than the year before. But month over month, it actually dropped. Inventory went down 7% last month. And that's actually the first monthly decline in active inventory after 7 months of increases. Still, we are high compared to that 10-year average, or about 21% above the 10-year average. And Vancouver's interesting. If you pull back to the 20-year average, we're still well below, because that, the 10 years before, that sort of 05 to 15, let's call it 2005 to 2015, way more inventory than we had from 2015 to today. But anyway, let's just look at 10 years because that's what the focus is on. And yeah, 20% higher. Now, interestingly, all three types of housing saw their inventory levels decrease last month. There's currently sort of no home type that is acting independently, right? It's not like condos are skyrocketing with inventory while detached is dropping. They're all ultimately moving in unison here, unlike our, let's say, friends in Toronto, which are seeing record highs in condo inventory. Now on to the big question that's on everybody's mind. What happens with inventory during the fall? Like I mentioned, the last two rate cuts saw an increase in inventory and a decrease in sales volumes. Will that repeat now that the third rate cut has taken place? As a quick early snapshot, let's see what's happened in the first 2 days of September here. We've had 2 days of sort of new listings and sales. There was over 1,000 new listings in the first 2 days of the month. Now, not too surprising. We always see relists and new lists within the fresh month. And here we are in September, right? And I think a lot of people were anticipating that rate cut and thinking, great, well, let's list now and kind of see if that cut stimulates the buyers. And there's also been about 200 sales in the first 2 days. So, way too early to make judgment here. But we will keep you well updated and report on sales and listings as they go on through the month, because I think September it's potentially a big pivot month. So we're going to track this one in real time for you.
Really interesting to see, like trying to predict, human behavior around this is so difficult. I mean, I think so many people have had different experiences. Some have sold, some haven't. Some have tried to sell. They've taken their stuff off. They've taken their listings off the market only to return them later on. So I think, there's a lot of different kinds of activity taking place in this market. And it's very kind of interesting to try and decipher what's taking place in buyers and sellers' minds right now. It works for some people and not for others. So it's very murky in that respect. And I think as we continue to wash this out, it'll become a bit more predictable. But as it is right now, it's everyone's kind of got their own circumstance, and it's very difficult to predict. At least I find it like that. Looking at the sales to active ratio here, overall, we're sitting at 14%. That's down 3% month over month. That's the fifth monthly drop in a row and the third month of a balanced market. That makes a trend. Guys, we're sitting well inside a balanced market and trending down. This is the third lowest reading in 4 years. In fact, breaking it down by asset class, for detached homes, we're sitting at 9%, down 3% the prior month. 18% for townhomes, down 3%. So that went from a seller's market into a buyer's market. It's holding on. And now apartments also down 2% at 17 overall. All three asset classes sitting inside of a balanced marketplace, except actually detached sitting in a buyer's market. Very, very interesting.
Yeah, and I love to contest the terminology that I guess the real estate boards come up with, right? Because they call it a buyer's market, and yet there's fewer buyers than ever, and then yet when prices are ripping higher and there's more activity, there's also more buyers in the market. So, does that make it a buyer's market too? I think it should be reframed as maybe an active versus a less active market or something along that framework. But either way, buyer's market, sure, I get it. It means that there are more favorable opportunities in a sense for buyers. And yet, again, the opposite happens when home prices are going up rapidly.
I think too, it should be more about the levels of standing inventory as opposed to, and I think that really should dictate whether or not you find yourself in a market that's levered more towards a buyer or levered more towards a seller. So I think, depending on how many months of standing inventory we have, that should very well be the indicator as well.
Yeah, I believe that's more commonly used in the Toronto board. Mm-hmm. And well, let's look at it that way. Right now, or at the end of August there, GVRD had 7 months of inventory. Yeah. 7 months. And if it sounds high, it's because it is. I mean, typically what they consider a balanced or flat market is around 5, maybe 6 months of inventory. Mm-hmm. So at 7, it's no surprise that prices are coming down. That's very typical of that length of time of homes on the market, essentially, or months of standing inventory. So let's talk about price then, because of course, like I alluded to off the top of this episode, prices are getting pushed down. The HPI saw its third consecutive monthly decline. Now, I made a prediction last week, and this is based on how far down the median and average prices have dropped during the last 2 months. So I expected a full 1% drop in the HPI, but the math has been done. The algorithm has taken place, and the HPI only dropped 0.2% last month. It's down 0.9% year over year now. So let's call it 1% year over year. Obviously went up for the first half of the year or quarter of the year, and now it's kind of trending down. Your HPI price today is $1,195,000. But let's look at the other two metrics because they tell an interesting story too, and a bit of a forward guidance story in my opinion, because median dropped 25 grand just last month, is also seeing its third monthly decline, down $65,000 in those 3 months. We're back to January numbers, essentially, where the median price now sits at $945,000. And the average price is even more dramatic. If you remember last month, the average price dropped $60,000. Well, August got on top of that and threw another $36,000, $38,000 more. So we've seen in the last 2 months, average home prices are down $98,000. We're almost at 6 figures here. And this metric is also back to January numbers. So any home price increases that we saw in early 2024 have now been evaporated. We're basically status quo to January. Average prices now sit at $1,252,000. An interesting thing to note with average prices. Should average prices drop another 12K in the month of September, we would actually be at an 18-month low for that metric. But clearly, it can move dramatically month over month. It can jump 50, 60, 70,000 next month alone. So we'll track that and let you know. But ultimately, it's these dramatic swings is sort of why the HPI exists, because it's more of a representation of a smoothed out marketplace. It removes the $20, $25 million sales kind of thing and the low end parking stall sales and kind of really represents more of what's actually going on in the marketplace. So you get an idea why that exists, but I also find it quite valuable to look at all three metrics to give you an idea as to what may happen moving forward.
It's in line with our our recent level of sales and kind of what's been taking place for our buyers over the last few months, there's a number of deals. I can't name them specifically, where we've achieved on average over $100,000 off of the list price, negotiating these prices down. So while the HPI may reflect one side of the story, which is probably the vast majority of sellers that are maybe trying to hold on for those higher prices or prepared to wait for a deal, the ones that are actually transacting are more in line with the average and medium prices, where we're seeing those kinds of drops. People are trying to get stuff done. We've to the tune of probably nearly $500,000 over August is kind of what we've been able to save for a number of our clients, and in total, that is. And so, we are seeing these deals taking place. We are seeing sellers taking hits and getting on and moving out and getting stuff done. But it is happening in line with the median and average price reductions, less so with the HPI. That's just kind of what I'm seeing as a boots on the ground interpretation of those stats, Dan. Having a look at our days on market, it's up 4 days to 21. So about 3 weeks to sell your property if it's appropriately priced. This has been the highest we've seen since January.
Yes, lots of references here back to January. And now looking forward, September, I think, is going to be one of the most interesting months we've seen in probably a year here, because we are absolutely going to see a flood of inventory. When it hits, we don't know, right? Like, we're still, even today, recording this on September the 5th, still under 15,000. That 15,000 ceiling has yet to be broken through, at least for any type of consistent time frame. Will it happen this month? I think it will. Maybe people now, having kind of seen that rate cut happen, will feel more confident in listing next week, saying, okay, fall market plus 3 rate cuts. There's got to be buyers out there, right? Well, we will see. That's for sure. We're going to see an uptick in volumes regardless. Will it be substantial? I don't know. I'm not feeling it quite yet. I think it's still going to be a sluggish September. More of that sideways, boring grinding to the right market, which is totally okay. That's fine. That's kind of what we like. Balanced market, grinding sideways. Hey, some normalcy for once would be just fine with me.
Yeah, it's like a level of stability in many ways. The rate cuts that we're seeing are coming down at a relatively stable rate, at a stable environment, compared to when they were rising, which it was anyone's guess. Was it going to be 0.25? Remember, a full basis point, like 1% hike, like dramatic changes on the way up. This is sort of a consistent line on the way down, in line with sort of the comments that Tiff has said. I think, they don't want anybody front running these decisions. So I suspect you're going to see this constant sort of 0.25 drop, but it's going to, in my opinion, it's going to take until 2025 before we really start to see volumes pick up again.
Yeah, it's interesting. It reminds me of that historical comment about the BOC and central banks typically taking the escalator up, but the elevator down. And this time they're doing the opposite. Right? Yeah. They took the elevator up and they're just kind of taking the escalator down. At least that's what we've seen for the last 3-4 months here.
Yeah.
Thanks, as always, for tuning in and listening. Hope you enjoy your September market, and we look forward to seeing you back here next week.